Oh my God, it's all working. Welcome back to the Syndicate, guys. I'm your host, Matt Ward, angel investor, serial entrepreneur, and advising a decent number of startups at this point. It's great. I'm a little bit ADD. I get to talk to incredible people and try to help them build their businesses. And that's kind of why I started the Syndicate, to get the best and brightest investors, angels, VCs, and accelerator guys from around the world so I could steal all of their greatest secrets and synthesize that for myself, network with some of the smartest, best people, and get guys like Michael Cardamone on. So thanks for coming today, Michael.
Yeah, no problem. Thanks for having me.
So Michael, you run Acceleprise. You're managing director there and a venture partner with the Sastre fund. I'm terrible with intro, so I would like to hear a little bit more about you. How did you get into this world?
Yeah, so I moved out to San Francisco in 2008. Got pretty lucky and ended up at a small startup called Box when it was about 25 people. Spent some time there. Frankly, didn't stay as long as I probably should have. Went to another startup that a friend of mine had invested in the ed tech world that I helped grow to about 25 million or so in revenue before I left. So most of my operating background over that kind of 6-year period was in kind of sales, BD, marketing, and then about 4 years ago started Acceleprise in San Francisco, which is a B2B SaaS focused accelerator based in San Francisco now, also with location in New York. We just launched in New York and then launching in Melbourne, Australia this summer as well.
Got quite a mix there. So Box, well, 25 when you leave. How many when you leave?
It was probably a little over 100 when I left.
Okay, I assume you didn't get away with any equity.
I did, yeah.
Oh, nice.
Yeah.
Very good.
Yeah, so I was there for almost a year and a half. So
okay, so that made life easier then.
A little bit, yes. Allowed me to dabble a little bit in some angel investing, which was good.
How'd that go?
It's gone well so far. Probably the best one was I was in the first round of Flexport, which is obviously doing pretty well, and also in the first round of Naturebox, which has done pretty well as well. So,
what's Naturebox?
They are a subscription snack company,
okay.
But I think they've raised probably I forget the number, in the tens of millions of venture dollars at this point.
So doing well, but not Flex. I mean, Flexport's unicorn at this point, right?
Almost.
If not, then they could be. That's the word on the street. Yeah. Very cool, very cool. So you've been doing well as an angel investor, and then you decide to start Acceleprise?
Yeah. So I had been talking with people in my network who were other people who were early at Box or early at Salesforce, or people like Nick Meadows, the CEO of Gainsight, and just a bunch of people in my network who were in the SaaS world, about how there were a ton of generalist accelerators out there, but there were only like 3 or 4 in the country focused on enterprise software and SaaS. And so we felt like there was an opportunity to do that in San Francisco. Acceleprise had actually already existed in DC, and I had gotten connected to the founders in the DC program. And instead of creating something competitive, decided to license their brand, but we raised a separate fund and set up a separate entity and separate partnership in San Francisco. And then one of their founders from the DC program invested in our first fund. They've actually since decided to kind of sunset the DC program because they all started companies that are doing well. Alan started TrackMaven, Sean started his own company. And so now I've kind of taken over the brand. And so then we were just in San Francisco for, like I said, 4 years, and we're still running in San Francisco, and then now moved out to New York fairly recently to help launch Acceleprise in New York.
How do you balance something like that? So these guys are running an accelerator while also starting a startup?
Yeah, so they went in DC. They had started the accelerator, and then Sean had a big exit initially, and then started the accelerator. And then while he was running the accelerator, decided to start a startup. Alan did the same thing, and then Acceleprise funded TrackMaven. TrackMaven's now kind of like a Series B company. Sean's company has raised probably 12 million or so. So they just didn't have the time to kind of continue to run the accelerator and put in the full-time effort that it would need to be successful.
Why'd you stick with it?
I mean, I I wanted to do it full time. Like you, I love working with and advising and a lot of different startups at the earliest stage. And so I felt like an accelerator was a good mix of still being like in the weeds operationally, but also formalizing a bit more of what I wanted to do on the investing side.
What are your goals?
Yeah, I mean, we want to build a globally recognized brand that's the leading accelerator for B2B SaaS companies. And so, we're in San Francisco, New York now through a joint venture and partnership with some in Australia. We'll be launching in Melbourne, and then looking at a couple other cities right now as well that will likely launch in early 2019.
How do you differentiate from a YC, a Techstars? While they're not specifically SaaS focused, they have more of a brand name. How do you win?
Yeah, so YC, I would say, is head and shoulders above every other accelerator right now, from what I can tell, as far as like brand recognition and being able to win deals. They've done an incredible job of building a brand. I think we're already we win and lose deals right now to Techstars and that next kind of tier down of accelerators. And I think why we win deals is, I mean, to speak to Techstars specifically, is like there's a lot of value in just being in San Francisco. San Francisco has a huge draw. Techstars doesn't have a presence there on purpose, but I think it also is a great benefit for us. The focus on enterprise software is key. A lot of the Techstars programs, if it's not a corporate program, they run generalist programs. So you're going to have work, and then you're going to have a whole slew of mentors that maybe they're successful in their own right, but maybe don't have any experience in SaaS. If you're building a SaaS company, that's not overly relevant. So the focus on SaaS, and then particularly with us, like we are we keep the cohort sizes small so we can be pretty hands-on, and so we're very in the weeds on sales. So like we really jump in on helping you with like ideal customer profile, messaging, pricing, and then we even go as far as like building lead lists for you, helping with outbound email campaigns, like comparing your sales funnel and benchmarking it against the rest of our SaaS companies. Like having that focus on sales and on SaaS allows us to be very hands-on on the go-to-market and growth side of things.
Benchmark specifically is super valuable because you're able to see. Tell me, what are some benchmarks that SaaS companies need to be looking for to raise a seed, to raise a Series A, maybe a Series B?
Yeah, I mean, so I actually wrote a blog post about this on Sastre a little while ago. It's a bit of a moving target. I think seed especially is all over the place. Like I see companies get funded pre-revenue, and then companies that have 30, 40, 50K in MRR that struggle to raise a seed, and they wonder why. So I hesitate to put out specific revenue metrics. But I would say the average person who's not a repeat founder but has good domain experience, first-time founder, in a space that's like fairly obviously a big market, but potentially a little bit crowded, like you need some traction. Oftentimes I see that at like 15, 20K in MRR is when it starts to become a little bit less friction in raising a seed round. Series A is a little bit different. I would say of the deals that I've looked at through the Sastre fund or just in general, or from Acceleprise companies raising Series A, is it's usually anywhere from like 500K to 2 million in ARR is when Series A's tend to get done. And a lot of when you're able to raise that is how well you're able to create urgency, how fast you're growing, how big of a market opportunity it is. There's a lot of factors that go into it, but that's about the pretty broad revenue range that I see a lot of Series A's get done. Yeah.
What do you look for growth numbers, like 20% month over month, 30, 40?
Yeah, I would say, in the 15 to 20% month over month is a pretty good growth going into an A. I would say in the early days, going into a seed, like ideally even a little bit higher than that, just because numbers are small, and so it's a little bit easier to see that month over month growth. But it also depends on, if you're selling into big enterprises, like it's not going to be a smooth month over month growth, right? It's going to be more like step function growth and chunky. So it kind of just depends. I think what's more important is having super happy early customers who will be referenceable that's like arguably more important at the seed stage than growth rate.
So when you're talking to startups, what KPIs are you telling them to track?
So it's a little bit different for every business depending on whether they're selling to enterprise or small businesses or whatever. But let's say the normal SaaS company selling to like a mid-market, we're looking at the entire sales funnel. So like meticulously looking at the sales funnel from like, how are you driving inbounds? How many inbounds are coming in and are qualified, and then demo to trial to close, like measuring that whole sales funnel and then kind of picking out each point in that sales funnel and looking at how can you optimize that point and then moving on to the next one. So we're very KPI driven around that. And then also, somehow measuring how happy the customers are early on. NPS is one way of doing that, although typically they need to be customers for a while before you start getting accurate results on NPS. But yeah, like figuring out like how do you get data on how happy the customers are with your product, whether that's engagement stats or anecdotal stats or NPS type stats.
And you have to do a lot of weeding out to get rid of the ego stats.
Yeah.
So there's a saying, software is eating the world. My question is it eating the world, or has it kind of already happened? Are we beyond the midway point for software as a large scale opportunity? I know you're biased on this, but I want to get as unbiased as possible.
Yeah, no, I mean, I think it's a fair question. I think in like a lot of kind of horizontal type of applications like HR and sales and marketing type applications where it's not kind of industry or vertical specific, you're probably a little bit past halfway. But I still think there's a lot of opportunity outside of like early adopter, like in the Midwest and other areas and globally, where it's still like relatively early in that shift. But I still think there's a lot of opportunity across like verticalized solutions and in certain industries that are slower to move. And then I also think like that first generation of SaaS companies like Box and Salesforce was basically like take something that was on-prem and move it to the cloud and make it like a slightly better UI. But I think there's going to be the next generation is all going to be about kind of, can you take applications that are built using AI and machine learning, like built from day one to like really automate a lot of the workflows. And you'll see big companies being created behind companies like Salesforce and Box, I think, in that next wave. So I think there's still a lot of opportunity, but obviously I'm biased. Yeah.
That's okay. That's how it works. Yeah. If AI is the next wave, where do you see blockchain fitting in?
I mean, blockchain as well. I'm relatively new. We're just starting to see inbound applications coming in from like companies building on the blockchain for the enterprise. And so I've been spending the last couple of quarters, I would say, trying to get smart on it. But still learning, still trying to figure out where it's gonna play. I still haven't seen a lot of use cases in production across the enterprise. I've talked to like some of the big companies in the space, like the big enterprises in the space, like IBM and GE, and like what they're doing around it. But there haven't been a lot of startups that have gotten like serious traction yet building applications on the blockchain. So I'm curious to see how it evolves, but we're paying close attention to it and certainly starting to see more and more companies building on it.
So if I'm a founder and I want to reach out and apply to Acceleprise, what's the best way for me to get in? How do I hack the system?
I would say a referral from someone in our network. So the best one is like from a previous founder who has gone through the program, or from one of our like pretty active mentors or advisory board members is probably the best way. Another way is through a VC where, if they genuinely are interested in the business, but it's just earlier than when they tend to invest. We take a lot of referrals from that crowd as well. But that has some nuances with it because it depends on like how well we know the investor and if they really are passing because it's too early. Yeah.
Yeah. How do you weed that out? That's always the challenge of, oh, this isn't a great opportunity for me. It's a little, yeah. But I think it's perfect for you.
Yeah. Yeah, I mean, so there's some people who just take a hard stop of like, I'll never take an intro or referral from a VC who passed. I don't think it's that hard and fast, because I do think like every fund has different kind of strategies and different things that they take into consideration, and maybe portfolio companies that are overlapped with a company, or they like by rule or by design won't invest pre-revenue. Like, you know, if we know the investors and like know there's a legitimate reason why they're passing or not investing right now, then that's fine. But if it's an investor we don't know, or we don't know what their strategy is, then it becomes harder to weed that out.
What's your fund size?
So we just closed our second fund for Acceleprise at $7 million.
Nice, good work.
Yeah.
How does it work as an accelerator with facilitating follow-on funding? I imagine you're networking your face off with all of the VCs and angels.
Yeah, so yes, we have built a pretty big network of investors and angels. We do a demo day just like any other accelerator, which, you know, demo days are, I think they're good for creating a forcing function for companies to like move with urgency and have like a specific date in mind that they want to like hit a bunch of goals by. And it's good for creating some urgency in the fundraising process because a bunch of investors in a room. But, you know, it's also like we don't take the hard and fast rule of like you have to fundraise around demo day. Like we look at when is the best time to fundraise for your business, and if it's earlier than demo day or after demo day, we'll help you with that process no matter when it is. But we do a demo day as well.
How would you reinvent that process? No one's really thought about it, but everyone does a demo day. That's just how it works.
Yeah, we've thought about it. I think it's. I mean, I think what we're doing is working fairly well, of just taking the approach that like, look, we're gonna do a demo day, but that doesn't mean you have to fundraise around demo day. Like, let's look at your business, get where when's the right is based on what's best for your business. And if the best time to fundraise is 3 months before demo day, like we're not going to arbitrarily tell you have to wait until demo day because you're in the accelerator. We're going to like work with you in earnest to come up with the strategy, come up with a list of investors, and make intros. So I think it's just like being like not forcing people into that, like you have to fundraise around demo day, but I think still having a demo day is helpful.
What makes a good intro?
Yeah, I mean, I think it's you actually understand why an investor would be interested, what types of companies they're interested, and then like making pretty curated introductions. So we take pretty like detailed notes when we meet with investors on like what they're interested in and why, what types of companies they've invested in, what stage, what are the things they care about, like are they willing to take technical risk versus like market risk versus founder risk? Like what types of risks do they generally feel okay with versus not okay with? And try to make curated. So, you know, oftentimes we'll make more intros to an investor in the beginning and then like help curate that down and then make more, you know, strategic and kind of filtered intros over time as we get to know them.
So what's something that I probably don't know about running an accelerator?
You probably don't know. I think one of the things is, I think it's a lesson that I've learned along the way, is you're so in the weeds with the companies and you're spending so much time with them over the course of the 4 months that you get to become like pretty friendly with a lot of the founders. And then when it comes to follow-on funding decisions, it becomes a challenge to kind of manage like that relationship you have with the founder and like the fiduciary responsibility you have to the LPs. And so I feel like I made some investments out of some follow-on investments out of the first fund, for not saying whether they were the right decision or wrong decision, but for the wrong reasons, I think.
Okay.
So I think that was kind of like a lesson learned in the early days of running an accelerator that maybe isn't like an obvious conflict. Yeah, so we try to create more rules around like when we'll invest, so it's more defined for the founders. Like we won't ever be a standalone follow-on investor. Like there has to be some other like sophisticated investor, either angel investor or institutional investor, coming in, investing in the round, setting the price. And it has to be over a certain amount of money, and then we'll likely follow on. but you know, we still can make exceptions along the way. So we try not to like make rules like, you know, that are so stringent that we can't ever make exceptions, but we try to just be more exceptions. Yeah, right.
Can you tell which startups will be successful, relatively speaking?
I think it's really hard at this stage. I think any investor who tells you they can with certainty is full of it. Like, I think part of what, you know, part of early stage venture especially is like you have to get lucky early in your career, and then that luck kind of compounds in that, like, you know, you're in a good company, then everyone wants you to invest in their deal. But yeah, so I don't know. I think so. But
so would that mean that it's kind of a little bit like so there's this scheme that they have for Wall Street guys. If you want to get people to invest with you, what you do is you have two different decisions. I'm either going to do this or I'm going to do this. You send out letters to 50% of the list for each one. And on the second decision, you do the same thing. And you keep doing that. And with one of those paths, you will be right essentially every time. You will be like the prophet god. Yeah. Is that a little bit how you see venture working? Is it's not so much, do you see how much is luck? How much is skill? How much is network?
I think network is a big part of it. I think there is some skill. So I will say, just going back to your last question, like, I think that running an accelerator actually gives you an advantage in the early stage of, like, you actually really get to know the founder and the accelerator over a certain amount of time, and can see how they're executing, like how relentless are they about building the business. You know, what are the early customer conversations, like really like insider baseball on like how the early customer conversations are going. Like, you have a lot more information. So I do feel like while it's still really hard to predict, like maybe it's not 50-50, like you have some edge because you've spent so much time with them and are seeing how they're executing. But yeah, I mean, to your question of like, how is that split? I don't know. I think there's like a reasonable amount of luck involved, but I do think there's some skill. And then I think network is hugely important, because I think having a really big network, which is, again, I'm biased because I run an accelerator, but like having access to a big network that can help accelerate getting intros to customers and mentors and investors, I think can like sometimes make or break a company in the early stages. I think that becomes less important as the company scales, though.
And that's the beauty of accelerators. If you do it well, it's an incredible investing model.
Yes. I mean, yeah, for sure. I mean, we'll end up probably investing in 60 companies in this second fund across New York and San Francisco, and on a relatively small fund. Like, we don't need multiple billion-dollar outcomes to 5x the fund. It's a pretty interesting model. But then you have to truly add value to the companies.
How do you scale that?
What's that?
How do you scale that?
Yeah, it's more locations, but locations at some point I think become dilutive if you start scaling to too many locations. So,
especially if everyone's doing the same thing and scaling to more and more location. Yeah,
right.
Every accelerator kind of has the same model, with the exception of YC, who can pretty much just say, "We'll just take." Yeah. It's an interesting end game. If you kind of run it out, eventually accelerators will start to get less and less because there's more and more coming in. But it's a great business model.
Yeah, no, it's good. And I think one of the things we've done from the beginning is, like, we have this like relentless focus on NPS of the founders going through the program. And so like we've spent very little resources on marketing, and instead focus on like, how do we deliver an amazing experience for the founders? Because at the end of the day, that will organically build our brand and organically build like the referral base, because they'll talk about how great of an experience it was in the ecosystem. And so we took the long-term approach on that of like, let's just go all in on like that being our core metric as an accelerator, and let it kind of build organically from there.
Smart guy. What's the score?
So our goal every cohort is to get 7 or higher. Most cohorts beat that. I think we've had one cohort where we were at 6.
Isn't 7 pretty much just the like Seven's like a push.
No, so most of the time we're eight and nine on the cohort. So it's basically usually we have out of call it 10 companies to make math easy, like 8 or 9 of them are promoters, and then you have like 1 or 2 that are neutral.
Okay.
I don't think we've ever had a negative one. It's either neutral or promoter. Yeah.
So I had a great question and it just totally dripped out there. So what are you excited about today?
From a company standpoint or just in general?
Just you personally, what are you excited about?
Yeah, I think I'm excited about, so with Acceleprise, like I feel like, we recently closed the second fund. We've had a number of companies raise Series A's recently. Like as an organization, we've hired a couple people recently. Like as an organization, we're building a lot of momentum, and I think have hit this kind of inflection point where now we have a lot of opportunity to grow in a number of different directions, either in other locations or raising a fund on top of it. And so I'm really just super excited about the next few years for Acceleprise and where it's going to go. And we'll see.
What about Sastre? How'd that happen?
Yeah, so Sastre, I got introduced to Jason through one of our LPs and advisory board members, Nick Mehta, who's the CEO of Gainsight. And so started to get to know him. And then just over time, I had mentioned that I was moving to New York and kind of pitched him on the idea of like, hey, is it valuable to you at all to have someone like part-time in New York evangelizing the Sastre brand and like looking at deals on the East Coast? And it took some convincing, but he finally, agreed to let me do that. And for me, it was like, he's done an incredible job of building the Sastre brand. I think he's also a really good investor, just given his like track record and companies he's invested in. And so I felt like it was a great opportunity as I'm building my portfolio and track record as an investor. And then also hopefully be helpful to him in like looking at some deals for him on the East Coast in markets where like maybe he's not paying as close attention because he's one person doing like 1,000 different things and building an incredible brand and running a almost $100 million venture fund on his own.
What does the dynamics of a venture partner agreement look like?
Yeah, so basically I just spend a small amount of my time looking at like net new deals. So first of all, venture partner is kind of different across a lot of different funds. Like it's defined differently. So for me in particular, it's like I spend a small amount of my time looking at net new deals and kind of like mostly on the East Coast, but in markets where like maybe Jason's not spending as much time looking at it. And then if I like a deal, I'll bring it to Jason, introduce it to Jason.
And that's like a carry share?
Yeah, on a deal by deal basis.
Okay.
Yeah.
Okay, very cool. Just curious. Every firm is different, so it's interesting to look at the dynamics.
Yeah.
I want to jump to the lightning round. How's that sound, Mike?
Sure. Sounds good.
What's the first deal that you did?
Personally or I guess personally was Naturebox, I think was the first deal I did.
Okay. What about Acceleprise?
I think, Acceleprise. Geez, I don't know. Our first cohort had like 7 companies. I don't remember which one we officially said yes to first, but it might have been a company called Allbound.
Oh, sorry. Go ahead.
It might have been a company called Allbound, which is in Phoenix, and I got referred to them through one of our mentors, Anthony Canado, who's the CMO at Gainsight, and who knew them. But yeah, they're doing pretty well. They're like Series A stage right now.
Okay, nice. Yeah, with 4 years, that's not terrible. What are you excited about today in terms of industries specifically outside of software?
Outside of software? I don't know. I spend so much of my time just looking at software. I don't spend a lot of time looking at.
What do you do for fun then?
I hang out with my kids.
Okay. How old are the
basically
kids?
My kids and then Acceleprise take up like 110% of my time. So
the 2 different kids, the 2 different families.
Yeah, exactly. My kids are 2.5, and the other one will be a year and a week. So like almost a year.
So you are super busy right now. Is it just tons of coffee?
Tons of coffee. I went from like 1 a day to probably 3 or 4 a day recently. My kids.
Okay.
My 11-month-old is a terrible sleeper. So.
Oh yeah,
a lot of coffee. Yeah.
Yeah, we're 4 months now, so that's a fun
Yeah.
game.
Oh, nice. Yes.
Any big misses?
Big misses. Yeah, I mean, so I didn't even meet with them, so it's not 100% sure I could have invested, but I think I could have. But Ryan from Flexport, when I invested in Flexport, Algolia was also in their cohort at YC, and Ryan was investing in Algolia and asked me if I wanted to do it, and I thought the search market wasn't going to be big enough, and so decided not to put some money in. But they're obviously doing pretty well. So
what's Algolia?
Algolia, they started in Paris and they went through YC, but they're like search as a service, like a search API to build search into your application. And they, I think they just raised I forget exactly how much it was, but a very big round led by, I think it was Excel.
Interesting. What if you had one question for founders before you invest, what's it going to be?
One question. I mean, I really just want to, so what I want to understand from a founder is just how can they confidently tell me why right now what they're doing is relevant? Like why are they doing it right now? Why is there an opportunity right now? And then how is the market going to evolve over time? And how do they fit into it? Like they need to be able to kind of see that, or at least convince me they see it in a confident way. And so, that's probably like one of the big things that I look for, but there's a number of other like kind of, look for someone who's like relentless about building a big business, like confident. I look at little thing like nuanced things of like how quickly do they respond to emails and stuff, because I think I don't have data on this, but just anecdotally think it's correlated to like how fast they're going to execute and how like relentlessly or maniacally focused they are on the business.
It is, but it could also be if you're checking your emails too often. But it's hard.
It could backfire on me.
If you could meet with any founder VC today, anybody that you would like have some coffee, chit chat, try to learn from them, who would it be?
That's a good question. I think Benioff maybe. I feel like I'm just like I think he obviously has done an incredible job with Salesforce, but yeah, I mean, I think it would be interesting to chat with him.
Okay. What about in terms of things you go to on daily, weekly basis to stay informed? Podcasts, blogs, YouTube, etc.
Yeah. So the Sastre podcast, the biased answer of.
Yeah. What about an unbiased one?
Yeah. So I don't know. I would say I go like Thomas Tungus's blog, Fred Wilson's blog. I read a lot. Mark Suster's blog. I read. So yeah, I read a lot of like venture blogs. I actually Leo, who I think was on your show from SUSE. I like his. I like a lot of. I know him fairly well, and he's invested in a couple of Acceleprise companies. But I like his content and blog that he puts out as well.
Very smart guy. What's overrated, overhyped outside of ICOs, of course?
Yeah, I was going to say that's the obvious one. Well, maybe not. I don't know. I think they're overpriced. Whether they're overhyped, I don't know. But
short-term overhyped.
Yeah. Yes. What's overhyped right now? I mean, so I think like obviously AI and machine learning were like pretty big buzzwords a couple of years ago. I don't think they're necessarily overhyped because I think it's like very real, but I think there are still a lot of companies that overuse the term when describing what they're doing. So I think there's, a bit of work to do to kind of weed through what's real and what's not on that front still.
You mean we don't have HAL yet?
Yeah, no.
So I know you're a super busy guy. You have an entire massive cohort to deal with. Where's the best place for people to check you out? Say hey.
Yeah, shoot me an email, mike@acceleprise.vc, and then on Twitter @mgcardamone.
Awesome. And is there any portfolio company you want to plug? Just one. Just one.
Well, I'll talk about one from our last cohort that Leo actually invested in, SUSE invested in, called Elliot. really charismatic, confident founder with like deep domain experience, growing very quickly. Recently raised the seed round from Sousa and Bowery, but they're doing really well. But it's also just we invested like pre-revenue, solo founder, no customers, and it's exciting to see how quickly they've kind of like turned into a real company.
Is it just me, or are there a lot more startups that are just choosing like somebody's name, like some fancy sounding semi-British name as the name of their startup?
There are a lot recently.
Thanks for coming on today, Mike.
Yeah, thanks for having me.
I haven't asked you that you want to leave people with.
No, I mean, I have a lot of, so I would just say there's been a lot of learnings from working with, I think we've invested in 70 plus kind of pre-seed SaaS companies now. So maybe, another time, but I think there's just been a lot of lessons learned from seeing that and seeing mistakes they've made or things they've done that have worked really well. So yeah, if you're a pre-seed SaaS company, feel free to reach out. I'm happy to be helpful in any way I can.
And if you're an investor that's looking to invest in some awesome companies, reach out to Mike. I'm sure he could do some great intros for you.
Yeah, thanks.
Thanks for tuning in, guys. Hopefully this has been helpful. If it has, we need reviews on iTunes. It's incredibly important so we can beat out all of the evil guys and win. The syndicate.vc/iTunes. Leave a review. Seriously, it goes a really long way in terms of helping us reach more investors, entrepreneurs, and get awesome guys like Mike on the program. Mike wants to know that people are leaving reviews. Trust me. Right, Mike?
Yeah, for sure. Leave a review.
Mike plugged it. I didn't as much as he did quite. So thanks for tuning in, guys. I'm going to cut this out now. Go grab some coffee and let Mike get back to it. Cheers.
All right. Thanks, Matt.
Awesome.